Hello class, this is Dr. Fenton. In Chapter 11, we're going to look at a couple of areas within the legal system where forensic accountants are used quite heavily. So let's get started. Lower my window here. There we go. It's Chapter 11, Litigation Support in Special Situations. Now on this page it starts talking about the antitrust laws, and I'm sure you've heard about these. And this of course is where we try to prevent one company from trying to drive out its competitors and then take over that entire segment of the business. If that happens, they might start raising prices, and the government and people in general feel like it's just not good for competition if you have one company that really dominates a certain market. On the next page. Okay, now if someone or some company believes that the antitrust laws are being violated, an individual or a company can file a lawsuit under the antitrust laws. So when this happens, both sides of the issue here really need accountants, whether it's the plaintiff, the one filing the lawsuit, or the defendant, the alleged perpetrator. Both sides need accountants to work through the numbers to find out, what the damages are if the legal system finds out that the defendant is liable. Again, it's not the accountant's job to decide the legality of this. The accountants, work the numbers up. Now, based on the numbers, the plaintiff might file a lawsuit, take it to court, and then maybe the defendant is found guilty. If that's the case, then what are the dollar amount of the actual damages? Well, the plaintiff has already made a statement, here are the damages. Then the defendant has to come in with an expert to calculate damages and say, well, you found I'm liable, now here's how much I think I owe you because of the damages. So the primary issue for forensic accountants is whether the defendant appears to have engaged in predatory pricing. Again, the accountant does not make the decision, but what will, for the plaintiff side, calculate the numbers and say, well, it looks like they might be. Here, attorney, you work with your client to see if you want to go forward with the lawsuit. Now, for this example here, I have a little button over here. I don't know if you can see it, but this is a very good illustration here. So make sure you read through this yourself. Now down below here, we see that predatory pricing is the act of pricing a product so low that the only logical explanation is to drive competitors out of business. The alleged defendant here looks like they have dropped the prices so low, below a business reason to do this, and its only intent is to drive the competitors out of the business. Once they're gone, then they have the whole market and can set the prices they want. This overall definition does not give a judge or jury much guidance on this, but the operational definition given in this general area is whether a company prices product or services below average variable cost. Average variable cost. And if so, then predatory pricing is present. So average variable cost to an accountant, that sounds, okay, that should be easy to compute, right? But if you just look at someone's financial statements or their tax return, they don't have revenues and cost broken all out into fixed cost, variable cost, semi-variable, semi-fixed. It's not shown that way. So just a cursory review of the statements or tax returns does not show you really useful information. That's when one side has to get in and start subpoenaing the records of the other side. Next page. So again, an accountant working for the plaintiff, before the lawsuit's filed, the plaintiff's attorney really calls the accountant in to look at the numbers. That person might only have those financial statements to work with. And so they do the best they can to try to figure out, does it look like predatory pricing is present or not? And like this paragraph says here, the financial statements don't give you much information to work with. Okay, but you might take information that you can gather from those statements and then do some preliminary computation to see if you believe that exists. It might end up being enough to help the plaintiff file the lawsuit. So again, this is not the detailed information that you really need, but it might be enough to get the case started. See, we're looking for average variable cost, right? And so then we have to look at the cost behavior. Now, hopefully this part of the chapter is just review for you. Cost behavior deals with the way costs change with respect to changes in the volume of activity. It's just a general definition of cost behavior. We're getting into variable cost, fixed cost, mixed cost, step cost, things like that. Now, managers within the company use this information in a variety of ways, like number one here, cost volume profit analysis, budgeting, overhead variances, and other items. You should know what a fixed cost is. Along a range of activity, that cost stays the same, and everyone knows that. Variable cost, along that range of activity, then if the activity increases, that cost increases. Next page. Get into mixed cost. You have a cost that starts out maybe at the very beginning is fixed, but then varies after that with activity. Semi-variable cost. You might have costs that increase at a decreasing rate, so semi-variable, and semi-fixed. You might have a cost that is fixed in a very short range, then jumps up like a step, fixed for another short range, that's a step cost. And then we have two basic assumptions that we almost always have to use in working in this kind of information. It's the relevant range assumption and the time assumption. Now, relevant range, you probably studied that in other courses, maybe economics courses. They deal with that quite a bit. And along the relevant range, we are going to predict cost will happen in a certain pattern. Now, get out of that relevant range, like a much higher level of activity, then the patterns that happen in the range before that might not hold true. Here's a simple graph that shows within the relevant range, then total cost, of course, will start with 0. We can say these are like the units being sold across the bottom. So revenue, if you don't sell anything, your total revenue is 0. The more you sell, and this is the dollar amount here, the more your revenues are. So the more activity you have in number of units sold, the more your sales revenue is. So this is the total revenue line. Now right here is where the costs start. Along this line here, this is the fixed cost area. This is the fixed cost line. So starting at 0, you have costs that are there no matter what. And they will stay the same if they are truly fixed cost. Let's put on top of that the variable cost line. This is the variable cost area. So since we put the variable cost area or line on top of the fixed cost line, this line here ends up being the total cost line. So total costs are comprised of variable costs that do change with activity and fixed costs that do not. The time assumption as well. If you take your economist courses, the economists will say, well, in the long run, all costs are variable. And I guess that's true. In the long run, what you thought were fixed costs, you have to increase those, or they go to 0 if the company goes bankrupt or whatever. So we're looking at the time assumption that within the relevant range, we're saying the ranges are units and time. Okay. Next page. Now there are various ways to estimate cost behavior. And again, I'm hoping this is a review for you. You can actually go account by account and see what's in there, estimate how the costs act. You can use some graphic analysis and the high-low method here. Scatter diagrams, they give you ballpark figures. You just point dots on a graph and just draw your own line. Maybe ballpark accurate. The high-low method, maybe a little bit more accurate. I'm hoping, again, this is review. Look at this example if it's not. But you put your change in cost over your change in units. When you divide, that gives you your cost per unit. And then use that to find out of your total cost how much is fixed. And please know that method for the exam. Regression correlation. Hopefully, again, this is somewhat familiar with you. Your y equals a plus bx. They discuss them here, but now in accounting terms, y is total cost. A is fixed cost. And you're going to add fixed cost to the next component, and B is the cost per unit, and then X is number of units. Okay, so that's in accounting terms what those are. So total cost equal fixed cost plus your variable cost, which changes with activity. Okay. This is a regression line when you get into plotting the points. Computer models will do this. Financial calculators will do this also. So I'm not going to get into all these steps here in regression. Again, hopefully you've had it. It's just plugging the data you have, all the data points you have, into the regression model, and then they give you this line. They tell you what part's variable, what part's fixed. So I'll let you read through this yourself. And another way to estimate cost is have engineers do the time and motion studies. And to make sure that you have good data to work with in these court cases, you need to be familiar with the accounting system in which you're trying to evaluate. So I have a little note here. It says this is a good example. Read this. Two companies allocate marketing costs two different ways. So as an accountant going in evaluating a company, you cannot assume the company you're looking at allocates cost like other companies you're familiar with. You need to ask the questions and find out how are they allocating cost. It's a good example. Now on this page we have the start of a case study. This is quite detailed, a lot of explanation, and just the numbers you have to read through yourself. Let me hit the high points on this though. Now, the Coho grocery store chain has been sued by Ohio Grocery under the federal antitrust laws. So we have Ohio Grocery as the plaintiff and Coho as the defendant. And they are in the Columbus, Ohio area. So some of the high points. During 2021 and 2022, the expert for Ohio Grocery Store found out that Coho only reported profits in 7 of the 24 months during this 2-year period. So is Coho actually reducing prices below what they should be? And so really, is Coho involved in predatory pricing? Well, merely the finding that Coho experienced losses does not show predatory pricing. No. Instead, the Ohio Grocery expert must show through analysis that during at least some of the reported 24 months of store operations, Coho priced their products below, and here's the term here, average variable cost. So can that be proven? Well, based on using regression analysis and so forth, Ohio Grocery's expert could only identify 2 months during the entire 24-month period that Coho might have priced their goods below average variable cost. 2 months out of 24. Is that enough for predatory pricing? Might not look so. Another approach, though, instead of going over the entire Columbus, Ohio area, is to break that out into sub-areas. And so what about the north, south, east, and west areas of town? When this was done, Ohio Grocery's expert found out that Coho had 7 stores in the east area, 5 in the west, 4 in the south, 6 stores in the north. More analysis was done by those quadrants. Analysis of revenue and cost data for the operating reports for Coho's 6 stores in the north shows the following. Look at this. The expert seemed to find that in 13 out of the 24 months that it appears Coho did not even cover average variable cost. Based on this analysis, narrowing it down just to the north area, smaller number of stores, and 13 out of 24 months, they decided we're going to pursue this court case. So they started in with the court proceedings. We can see here that Ohio Grocery's expert analyzed the combined store operating cost of the 5 Ohio grocery stores that were deemed to be competitors in the north area, competitors with Coho. Now, this paragraph, or the sentence right above it, I didn't highlight this, but let me do that right now. During the 2 years of the alleged antitrust violations, look at this. The 5 Ohio grocery stores located in the north had average monthly losses of $387,000. So they had losses on the average every month. That's why they feel like maybe Coho was involved in anti-predatory or predatory pricing. So let's go here. Okay, so when you read through all the detail here and the detail on the previous page, you'll find out that Ohio's groceries expert said that we believe that we should have had $81,875 in the low range of profits each month, or on the high range it could have been $222,907. This is a range. We believe our profits would have been within this range here. So to find the total amount that Ohio Grocery believes the damages were, it goes from over 11 million, and that's taking this profit down here times 24 months, plus the losses they actually had for 24 months. So they're saying these are the profits we should have had, these are the losses we had, this is all damage, that's 11 something, and then here they say the high range 222 times 24 plus the loss for 24 months. The high range is over $14 million, and they believe this is within 95% confidence level. So quite a bit of money, quite a bit of money. Now the defendant, they don't show all the defendant's calculation numbers, in this problem, but the plaintiff is trying to show the defendant was trying to drive out businesses, and the prices were unreasonably low, below average variable cost. But the initial goal of the defendant's expert is to show that the plaintiff itself had some periods in which a store sold products below average variable cost. So if the plaintiff is doing the same thing as they're alleging the defendant did, then is there really harm being done? And so it just talks about what the defendant will do. You can read through here. And again, like I said, they don't give the exact or any computation the defendant would do, but the defendant would go through, see what they could find out about cost behavior. They have Coho's own numbers. The defendant side does. They're the defendant. So they'll just go through the numbers and find out again what they have as to what they've done as to average variable cost and prove they were not below that. And they would subpoena Ohio Groceries records and go through their records to see if they were doing what they alleged Coho to be doing. So anyway, a detailed explanation, so please go through it. It's very good. Now here, wage fixing agreements, those are part of the antitrust laws, and so this is to help employees. So I want you to read through this. Even the FTC and DOJ have published the antitrust guidance for human resource professionals, and it talks about these wage fixing agreements. Another area where forensic accountants can help out is the Federal False Claims Act. This is a very interesting act here. It was passed quite a long time ago to protect the government from the unscrupulous acts of government contractors who intentionally or carelessly overcharge the government for goods and services. Now look at here. I didn't highlight this, but let me do it right now. Put this in yellow. And look at this. In the fiscal year 2019, the Justice Department recovered more than $3 billion from false claims cases. $3 billion. There were 636 qui tam suits. This is where the individual filed the lawsuit in court and continued with the case. And 146 non-qui tam suits. This is where the government took over the case. And so the whistleblowers themselves, you have to have someone to report this usually. The whistleblowers received $273 million. So yes, sometimes whistleblowers get paid a portion of the recovery. We'll see that in just a minute. And we're looking at sometimes allegations of fraud, right? Now, there could be intentional fraud here or sort of non-intentional fraud, but the way this is worded, it's easy to get into fraud, even without a lot of intention here. Now, the Supreme Court held in 2016 that the mere filing of claims for payment under a government contract may be enough to find liability under the implied false certification theory. Applying this theory is very interesting. When a defendant submits a claim, it impliedly certifies compliance with all conditions of the payment. So just the fact of filing the claim for compensation under the contract, you've done your work, you produced your product, you file the claim, the government pays you. Filing that claim is you certifying this is accurate. And if it's not, then it could be brought up later on as, like it says here, fraudulent misrepresentation through omission. Okay, so, talked about whistleblowers here. They can be current or former employees. They're alleging the contractor has intentionally overcharged the government. Now, the whistleblowers can proceed in two different ways. They can contact the Department of Justice and say, here's my information I have, and here's the evidence. And then the Justice Department might take up that case and continue with it and file the case itself. If the government says that's not enough for us to pursue the case, the individual can pursue the case in court also. That's the qui tam suit. Now, whistleblowers, they might file the suit to initially get this on the books. That might get the government's attention, right? Oh, someone filed the suit. Let's take even a closer look at this. Maybe they came to the government beforehand. The government said no. But actually, after the suit is filed, the government might take a closer look. Okay, and the government might take over the case, part of the case. And if they take over part of the case, then the whistleblower can take over the other part of the case and pursue it in the court system. Sometimes we're talking 15 to 25% of damages might go to the whistleblower. Sometimes 25 to 30%. In reality, most whistleblowers don't receive hardly anything, sometimes nothing. Sometimes they lose their job. They shouldn't. Sometimes they do, though. If they quit their job, sometimes it's hard to find another job, right? So it is a risk they take, right? But again, with those cases we saw earlier, I guess the previous page there, quite a few cases were filed and over $3 billion was recovered by the government. Now the accountant, they can help in these kinds of cases. They say what cost should be included in the contract, how should the cost be measured, and a number of other things. So again, we're looking at cost here. Was the government billed too much, too high of a price under the contract? You need to get the accountants in here to find out more about the numbers. So again, a lot of work for forensic accountants. Intellectual property, I'll let you read through this yourself. We're talking, of course, trademarks, copyrights, and so forth, and to get into how much should the damages be. You use my copyright. You need to pay me something. So the accountants can get in here with these numbers as well. Further, patent infringement. You hear about this quite often, and again, the forensic accountant can come in and help compute damages that could be present in this kind of situation. Of course, the harmed company, the one holding a patent, they might file a patent infringement lawsuit, and they want the offending company to cease and desist and then reimburse the plaintiff here for any damages up to that date. And of course, a lot of components can be involved here. The Georgia Pacific case was a Supreme Court case, and that case came up with 15 factors to determine the monetary damages in this kind of case, right? So you can read through these, you go on to the next page, and these factors have been used by later cases to decide how much should the damages be. So make sure you're familiar with this case if you get involved in these patent infringement kind of cases. A couple more alternatives here. You can read through this, and I'll let you read through this, royalties and so forth. And then that's the end of the chapter. So, some detail in this chapter as well. And that's the end of it. But as always, good luck with your studies.